Ripple just raised $500 million at a $40 billion valuation from Citadel and Fortress, two of the biggest names on Wall Street. The headlines are everywhere. Crypto Twitter is celebrating. Reddit forums are buzzing. Everyone's talking about what this means for the future. But here's the question nobody's asking. When Citadel puts hundreds of millions into Ripple, what exactly are they buying? And more importantly, is that the same thing you would be buying if you followed the hype? Spoiler alert, it's not even close. Today we're breaking down one of the most important lessons in finance that most people completely miss. The difference between investing in companies that build infrastructure and speculating on digital assets tied to those companies. This isn't about whether Ripple is successful, it's about why Wall Street's success doesn't automatically become yours. And understanding this distinction could save you from making very expensive mistakes. If you're here for honest financial education that cuts through the noise, hit that subscribe button. We don't sell dreams here, we explain reality. Let's get into it. Let's start with the facts, because the details matter more than most people realize. In late 2025, Ripple closed a $500 million fundraising round. The valuation? $40 billion. The investors? Citadel, one of the most sophisticated hedge funds in the world. Fortress Investment Group, a major alternative asset manager, along with several crypto-native funds. But here's what makes this interesting. This wasn't just a check-writing exercise. The deal included structured protections, rights for investors to sell shares back to Ripple under certain conditions, downside protection mechanisms, governance rights, all the things institutional investors demand when they're putting serious money to work. In the same year, Ripple acquired 4 companies. G Treasury, serving about 1,000 corporate clients with treasury services. Hidden Road, now called Ripple Prime, providing services to hundreds of hedge funds. Rail, handling 10% of global business-to-business stablecoin payments. And Palisade, bringing multi-party computation custody technology. Ripple now holds over 70 licenses globally. They obtained a National Trust Bank charter from the U.S. Office of the Comptroller of the Currency. That's the OCC. This allows them to operate across all 50 states without needing state-by-state licenses. They have licenses in Luxembourg for European operations, Japan, Australia, and the list goes on. Monica Long, Ripple's president, stated clearly, they have no plans for an IPO. They're staying private. Their focus is building digital asset infrastructure for institutional clients, corporates, hedge funds, financial institutions. Their strategy centers on compliance, custody, on and off ramps, and tokenized asset solutions. Now, here's what most people hear when they see these headlines. Wall Street is betting big on crypto. This validates everything. We're still early. Time to get in. But that's not what's happening. Not even close. Let's talk about what Citadel and Fortress actually bought, because this is where most people get it completely wrong. When these institutional investors put money into Ripple, they're not buying digital assets on an exchange. They're not speculating on price movements. They're not hoping something moons. They bought equity in a private company. What does that mean in practice? It means they own a piece of the business. They get voting rights. They have board representation or governance influence. They receive financial statements. They can negotiate exit terms. They have legal protections. If things go south, they have contractual rights to get some or all of their money back under specific conditions. They're investing in cash flows. Ripple makes money every time someone uses their payment rails, every time a corporate client uses their treasury services, every time a hedge fund uses their custody solutions. Every transaction that flows through their infrastructure generates revenue. That's what Citadel is buying into. Predictable, recurring revenue from real business operations. They're buying licenses and regulatory moats. Those 70-plus licenses, that national bank charter, those took years and millions of dollars to obtain. They create barriers to entry. Competitors can't just copy that overnight. That regulatory infrastructure has real value. They're buying management and control. When you invest at this level, you're partnering with the leadership team. You're helping shape strategy. You're not just a passenger hoping the price goes up. You're in the room where decisions get made. They're buying downside protection. Those structured provisions in the deal? That's Wall Street doing what Wall Street does best: managing risk, making sure that even if things don't go perfectly, they have ways to recover their capital. Now, contrast that with what happens when an individual sees these headlines and decides to participate in the crypto market based on this news. They go to an exchange, they buy a digital asset, they have zero governance rights, zero access to financial statements, zero control over anything, zero downside protection. Their only hope is that someone else will pay more for it later. That's not investing, that's speculation. And those are two fundamentally different activities. Let's dig into how Ripple actually makes money, because understanding the business model is crucial. Ripple generates revenue from transaction fees. When banks and corporates use their cross-border payment infrastructure, Ripple takes a cut. When businesses send stablecoin payments through their rails, they charge for that service. This is infrastructure revenue. It's tied to volume and usage, not to the price of any particular asset. They make money from custody and treasury services. Through their acquisitions, they now provide secure storage and management solutions for institutions. Hedge funds pay fees to keep their assets safe and mobile. Corporates pay for treasury management tools. These are software as a service and financial services revenue streams. They benefit from licensing and compliance services. Other companies pay to use their regulatory infrastructure. Their licenses allow partners to operate in jurisdictions where they otherwise couldn't. That access has value, and it's monetizable. The key point? Ripple's success is measured by transaction volume, client growth, and institutional adoption. Their business model works better with stability and predictability, not with wild price swings. In fact, extreme volatility makes their services harder to deliver and less attractive to risk-averse institutional clients. This is the opposite of how most people think about crypto. Most people think success equals price going up. But for an infrastructure company, success equals reliable systems processing high volumes at low cost. Those are not the same thing. When Citadel invests in Ripple, they're betting on growing transaction volume, expanding client bases, increasing market share in institutional digital asset services. They're betting on the business, not on the token. This distinction is everything, and it's exactly what most retail participants miss. Now let's talk about how this institutional news gets weaponized into speculation bait, because this pattern repeats constantly, and recognizing it is essential. Step 1. Real news breaks. Ripple raises $500 million from Citadel and Fortress. This is legitimate business news. It happened. It's significant. Step 2. The narrative shifts. Social media influencers and crypto promoters reframe it. Wall Street is buying in. This is massive validation. The institutions are coming. We're still early. Suddenly, infrastructure investment gets portrayed as a signal to speculate. Step 3. Retail FOMO kicks in. People who don't understand the difference between equity investment and asset speculation start buying on exchanges. They think they're doing what Citadel is doing. They're not even remotely. Step 4. The reality gap. Citadel owns part of a business with protections, governance, and revenue streams. Retail speculators own a volatile asset with zero control and zero protections. When the market moves, these two groups experience completely different outcomes. Step 5. Confusion and blame. When things don't work out as expected, retail participants feel misled. But they were never doing the same thing as the institutions. They just thought they were This playbook isn't unique to Ripple. It happens with every major crypto news story. Major bank announces blockchain pilot? Buy the token. Tech company explores NFTs? This is the validation we've been waiting for. Every time, the same pattern. Infrastructure news becomes speculation fuel. Here's the trap. The initial news is usually true and often positive. But the leap from institutions are building infrastructure to you should speculate on related assets is where people get hurt. It's like hearing that Caterpillar just got a $1 billion contract to sell construction equipment to China. then deciding that means you should day trade Caterpillar stock options with money you can't afford to lose. The business success doesn't automatically translate to your speculative success. Wall Street makes money from building and owning infrastructure. Retail speculators try to make money from price movements. These are not the same game. And when you play a different game than the people you're trying to copy, you get different results, usually worse ones. So here's the smarter question to ask. How do institutions actually build wealth? And can we learn from that approach instead of just trying to copy their headlines? Institutions build wealth through equity ownership. They buy pieces of businesses that generate cash flows. They hold those positions for years. They participate in governance. They have legal rights and protections. This is the core of institutional investing. Ownership of productive assets. They build wealth through risk management. Every institutional deal includes protections, downside hedges, exit rights, covenants, diversification. They never put all their eggs in one basket. They structure their investments to survive worst-case scenarios. They build wealth through information advantages. Institutional investors have direct relationships with management teams. They receive detailed financial data. They conduct extensive due diligence. They're not making decisions based on Twitter threads and Reddit posts. They build wealth through patience and discipline. Citadel isn't flipping their Ripple investment next week based on market sentiment. They're holding for years. They have a thesis. They're executing a strategy. Emotions don't drive their decisions. They build wealth through diversification. No institutional investor puts everything into one asset class, let alone one speculative position. Their Ripple investment is one small part of a massive, diversified portfolio spanning multiple asset classes, geographies, and strategies. Now, can individuals apply these principles? Absolutely, but it requires thinking differently than most crypto participants think. It means focusing on building equity value in your own skills and businesses, becoming genuinely better at something valuable, creating income streams you control. It means investing in productive assets for the long term, businesses that generate earnings, real estate that produces income, diversified portfolios held for decades, not days. It means developing real financial literacy, understanding how businesses work, how valuation works, how risk management works, reading actual financial statements instead of price charts. It means accepting that slow and steady beats fast and volatile. Compound growth over decades beats speculation every time. The institutions you're trying to copy built their wealth this way, not by chasing crypto headlines, by owning productive assets, managing risk, and thinking in decades. Let's talk about real alternatives to speculation, because this is where we shift from critique to construction. Alternative 1. Invest in your earning power. The highest returning investment most people can make is in themselves. Learn high-income skills. Get certifications that increase your marketability. Build expertise that compounds over time. Whether you're in technology, healthcare, skilled trades, business, or any other field, becoming genuinely excellent at what you do delivers better risk-adjusted returns than speculation. Alternative 2. Build or buy productive assets. Real wealth comes from things that produce value regardless of market sentiment. A business that solves real problems and generates cash flow. Real estate that provides housing while appreciating. Intellectual property that creates ongoing revenue. These assets work for you. They don't require someone else to pay more later. Alternative 3. Long-term, diversified investing. This is what actually works for wealth building. Invest regularly in diversified portfolios of productive companies. Hold for decades. Let compound growth do the work. This isn't exciting. It won't make you rich next month, but it's how millions of people actually built lasting wealth. Alternative 4. Financial education. Invest time in understanding how money actually works. Learn about tax efficiency, asset allocation, risk management, behavioral finance. Read actual books on investing, not just social media threads. This knowledge protects you from expensive mistakes and helps you make better decisions over time. Alternative 5. Building multiple income streams. Instead of betting on price appreciation, build systems that generate income, freelance work, consulting, small business ventures, rental income, dividends from investments. Income is more reliable than capital gains, and it compounds faster when reinvested. The pattern across all these alternatives, they're about building value, not extracting value. They're about creating something, not betting on something. They're about control and patience, not speculation and timing. This is how institutions think. They build, they own, they manage risk, they think long term. They don't gamble on narratives. And here's the reality. You have access to most of these strategies right now. You don't need to be Citadel to invest in yourself. You don't need to be Fortress to own productive assets. You don't need Wall Street connections to build wealth systematically over time. What you need is to stop confusing infrastructure headlines with personal investment opportunities. Stop thinking that because institutions are building something, you should speculate on tokens related to it. Let's bring this home with the core insight that changes how you think about all of this. When Citadel invests $500 million in Ripple, they're making a calculated business decision based on proprietary analysis, negotiated terms, and institutional resources. They're buying equity with protections and governance rights. They're partnering with a management team to build a regulated financial infrastructure company. Their success is tied to business execution, not market sentiment. When an individual hears that news and buys digital assets on an exchange, they're doing something completely different. They're speculating on price movements driven by supply and demand dynamics they don't control and often don't understand. They have no governance, no protections, no inside information, just hope that the price goes up. These are not the same activity, and pretending they are is how people lose money. This isn't about whether Ripple succeeds as a company. They might build an incredibly successful infrastructure business. They might process billions in transactions. They might become the standard for institutional digital asset services. That would be great for Ripple. Great for their equity investors, great for their institutional clients, but none of that automatically translates to success for retail speculators. The business succeeding and the asset price going up are not the same thing. Sometimes they correlate, often they don't, and you have no way to know which will happen or when. The real lesson here is about how to think about money. Wall Street builds wealth through ownership of productive assets, risk management, information advantages, and long-term thinking. They don't build wealth by following headlines and hoping prices go up. You have the option to adopt that institutional mindset, to focus on building real value, to invest in productive assets with proper diversification and time horizons, to develop skills that increase your earning power, to think in decades, not days. Or you can keep trying to front-run institutional headlines by speculating on assets you don't control, don't fully understand, and have no governance over. One of those paths has created lasting wealth for millions of people. The other has created a lot of regret. So ask yourself, do you want to understand how institutions actually build wealth? Or do you just want to chase what institutions touch? Because understanding how Wall Street thinks is infinitely more valuable than trying to copy what Wall Street does. This isn't an anti-technology argument. Blockchain infrastructure might transform finance. Ripple might be a huge success, but that doesn't make speculation on related assets a good idea for individuals who don't have institutional resources, protections, and strategies. The smarter play is to learn from how institutions invest, not from what they invest in. Build value, manage risk, think long-term, own productive assets, control what you can control. That's the reality nobody wants to say out loud, but everyone needs to hear. If this perspective was valuable, subscribe for more honest financial education without the hype. Drop your thoughts in the comments. Are we confusing infrastructure success with speculation opportunity? Let's talk about it. And remember, this isn't about whether Ripple succeeds. It's about why Wall Street's success doesn't automatically become yours. Thanks for watching. See you in the next one.